Hello everyone. Feels to me I always start the webinar this way. Theunis Kruger from South Africa. We're also in lockdown, so a lot of people are staying at home. Yes, so just before we start, as always, this is the foundation of online training part 2. Yes, last week we had part 1, which will be recorded. But before we start, I just want to check if you guys can hear me, if you can see me. That's just important. Yes. Morrison said I can hear me. Can anybody else hear me? I see there's about 8 people attending. Usman, Yogesh, Rice, Kevin, Aliu. Can you guys hear me? Moin said he can definitely hear me. Anybody else? I need at least 2 people to confirm that they can hear me before I continue, just to make sure. While we wait for the second one, here's my email, guys. So please write this down or take a screenshot or something. If there's any questions you have, then I want them answered. I want you to help them to get them answered. That's part of the learning process. So Alius also said that you can hear me, so we can continue. So this is my email, guys. Please write this down. Like I said, I'll take a screen print. Questions is a very, very important part of the learning process. What we're going to do today is part of the foundation of online training part 2. And that is, we already did part 1 last time. And I had some emails, some questions that I answered. And if you want to listen to it again, just let me know. You can email me, and then I can send you the link to the recorded webinar. We did the introduction. I'm not going to do that again. I'm just going to quickly fly through this. Just to recap, introduction, we talked about FXTM invest. That's if you don't want to trade yourself, you want to actually follow an investor, that is good. And that is also important because not everybody wants to become, has a passion to become a trader, just like a doctor, just like a lawyer, just like a plumber, electrician. Right, the foundation. We went up until the trend last time, so we discussed the trend. That is very, very important. That's the basics, the basic structure of this language of the market. Uptrends, downtrends, and ranging markets, right? That is very, very simple. There's nothing more than that. Just uptrends, downtrends, and ranging markets. Today we're going to talk about, okay, now we know the uptrends, downtrend, and ranging markets. So where do we get involved? Where do we take a calculated risk? And that's part of the foundation. You understand where the market gives you an opportunity. You take a calculated risk and you manage that risk. That's what we're going to talk about today. The method, where's the areas? We define it. We want it to be clearly defined. Actually, the market tells us exactly where to enter, exactly where to put your stop loss. That's what we're going to look at. Right, then we're going to discuss, we're going to go through a long trade example, a short trade example. We're going to discuss risk management, why it's so important. It's got 2 aspects actually. And then very quickly, FXTM invest. The first time I talked from an investor side. So you were somebody that didn't know, or you were still learning, and you can follow investor. There's a certain strategy there. This is when you have become a trader yourself, and now you want to share your strategy, or you want to be able to share your strategy, the profits you make with other people. Then we're just going to talk quickly about the strategy from the strategy manager side, and then questions and answers. Anytime if you've got questions, please put them on there in the question side, and then I'll every now and then I'll check, and then I'll get them answered. Right, I'm not gonna go through this. This is what we discussed in the first one. This is the structure of the market. This is actually all that we are looking for. This is uptrends, downtrends, and this is the early stage of a next trend. That is the areas that we look for. We want a simple method with good money management and risk management to get involved in the markets in those areas, right? I just want to emphasize that just going through this presentation, this is the thing we talked about last time. I want to emphasize, guys, that this method that I'm sharing with you is not going to make you rich, right? The purpose of this is to simply to get you going, so you can start practicing. It's almost like if you start riding a bike, you put on training wheels because you haven't got the skill yet. Put on training wheels and you get some, place with some soft grass where you can practice. If you fall, you know you're going to fall. You're going to try something, you're going to practice, and you're going to learn. Right, so this is actually like a training wheels that we put on, just to help you to get to know the structure, so you can start practicing, actually building muscle memory, if they put it like that. Right. So I want to go through this so that people that last time watched this can just quickly recap. So as I'm flying through this, just think by yourself, oh, I remember that. I remember that. I remember that. If this is unfamiliar to you, then ask questions. Write down the question somewhere there and email me and ask so that we can get it answered. All right. This is what we do. This is technical analysis. It is actually, we are studying market action using price charts. Why? Always why, guys? Just to identify a new trend in its early stages. That is the only reason why. If you do it for other reasons, then you are actually in the entertainment trap. This is the uptrend. This is how we define it, the structure. This is a downtrend. This is how we define it, right? This is a ranging market, no consecutively higher tops and bottoms. Right, and now we are actually going to start by discussing and showing and looking at an example, right? So what we have here is definitely, you can see there's a downtrend. Downtrend means we have lower top, there's a lower bottom, a lower top, a lower bottom. So the downtrend started there. It made a lower bottom, lower top, lower bottom, lower top, lower bottom, lower top, and then something happened here. There was a higher bottom here. That was an indication from the market. The structure of the market is changing. A downtrend would have had a lower bottom. That higher bottom is a warning signal, right? And if you identify that specific trend there with the trend line, you will see it can continue after that, doesn't matter. But if it breaks through there, then that is an alert for us. It's a warning, right? It's a warning for us to start looking, to start being aware of. Now we're going to use the structure of the market. Sometimes I'm going to just jump to a live chart. When the guys start, because so many people when they begin, they study candlesticks, they study um, Elliott wave theory, they study all sorts of theories, resistance and support levels and indicators and things. That's actually step 2, right? The structure is more important than that. I don't care where you use your support and resistance levels, everything. If the market is in a down structure and you start taking long trades here, you're going to get hurt. We listen to the market structure. That is why if guys get confused with that, I take them back. I tell them, let's simply look at a normal line chart, which is in actual fact the structure of the market without any emotions, right? So what do I see here? I see an uptrend, and then I see a bit of a flattening there, and then I see another uptrend, and I see a downtrend, and there the downtrend actually accelerated. I let the guys, I asked them to practice this over and over and over and over. And the reason why is to build the muscle memory of the importance of the structure. Any position you take is based on the structure we're looking for. Remember what we said, the early stage of an next trend. That is what trading is about, especially when you're learning. What happens is, just like many other things, when you master the basics, then you get insight, you get that muscle memory, and then you start seeing other opportunities within other, within lower time frames and so on. But the structure will always be the main thing. It just makes sense, guys. If you get involved in an early stage of a next trend, then the risk you take from a business point of view is small compared to the potential profit you can get, right? This is just one example. Many times you don't get trends that go very far. Sometimes the market is generous, sometimes not. We need to be able to manage our risk with every single trade. right? And then be able to take what the market wants to give us. So that's what we're going to discuss here. That's the purpose of the method, is just to define for you here. This exercise is very good because it's simple. It's the structure of the market without the emotions. When you put in the candles, then the emotions comes with. Now you need the emotions in the end, because the candles or the emotions of the market is going to tell you exactly where to put your stop loss, exactly where to put your entry, right? And then we use money management. I use a risk reward one-to-one to manage our profit, right? So this is very, very important. So if you still get confused with candles, then it's a very, very good exercise to go and practice there to see the structure. And another client of ours actually started practicing this and then showed me and it clarified it for him. So what he started doing is just to draw in the candles, draw in that structure, because he used to get confused with the candle. So you start drawing in the structure just to practice that muscle memory, guys, to practice that seeing the structure. The structure is in the end what's going to make the difference between you being a good trader, consistently profitable trader, or not. Right now, you can see the structure there within the candles. I'm identifying it. Now, if I go to the line chart, there's the line chart is the structure without emotions, and there I've got my emotions drawn in, and it's a little bit different because emotions are unpredictable. Right. So we need to see that specific point with the emotion to take our decisions. That's what we're going to go. Right. Let's continue. It's just a little bit of background, and just to give you more information. So the more information you have, the better your foundation. Talk about a root system sometimes also, right? So what we've got here is we've got definitely a break in a trend, and here we've got a higher top, a higher bottom, and when the price moves past that higher top, that would be a good place to enter when it moves. And if it should engage you there and it moves back and it goes past that higher bottom there, then obviously the structure is not intact anymore, then it's not uptrend anymore, then we protect our account and we get out. This is just a very simple way. I'm going to make it a little bit easier for you. This is also very important. We're talking about a simple, well-defined method. So if you've got a method currently that looks like this, don't be surprised if you get confused, right? Clutter brings confusion, and we don't want that. We need to simplify, right? And this is just a picture I love. Guy sitting there staring at this grid, and he's in his mind. He thinks he's still in the box. Meantime, the box is open, right? The problem, or the bottom line, is if you focus too much on your problem, your indicators, all these theories and things, then you miss the whole point. The solution is it's open, guys. This cat can jump out anytime he wants. The open part, the part that sets you free in this market, is knowing the structure of the market, listening to the market, having a simple, well-defined method. That's part of the foundation, which I call it, and having a high probability risk management. And then obviously practice, practice, practice. How do you get into your mind? How do you master any skill, any language, from walking, talking, anything, riding a bike, car, become a pilot, becoming a plumber? It's a set of skills that you figure out the basics, and then you practice over and over and over, and you build that mind, that muscle memory, build your mental framework. Right. So I call this the simple strategy that I compounded, or that I put together to help you guys. I call it the moving average spring strategy. And I want you to imagine a spring. If you compress that spring, right, what happens? You know exactly what's going to happen. You know the spring wants to decompress, right? And depending on how it was, how strong the spring is, the same power that it was. The stronger the spring, the stronger it will want to, the power it will want to exert to relax again. So just keep that in mind. Right, so we're going to use that when we are discussing this. Right, now the first thing we're going to use is a long trade, and I want you to realize that price is king. The price is the structure, it defines the structure. No indicator, no theory, no level, support and resistance level is more important than the price. Many times I get guys that they place more emphasis on the support and resistance levels, and when it comes close to the resistance levels, even though it's still a downtrend, for example, let me somewhat draw it, and I see I missed this thing. So see some of the other guys are still using it. So what you've got is you've got a downtrend here, and then let's say there's a support level, possible support level on this thing. And now you get guys, they think, oh, this is very important. And they start, when the price starts coming closer, they start taking buying positions there. But the structure of the market, guys, is still a downtrend. And then what simply happens is the market continues, those guys lose out. All right. So the most important thing for us, price is king. We look at the structure of the market. Yes, it is handy to see those levels. And if the market then does not continue down, but makes a, doesn't make a lower bottom, it makes a higher bottom, the structure changes, then obviously we are allowed to take in the early stages of an exchange the calculated risk. But there's a world of difference between letting the structure tell you where to enter and entering based simply on indicators and support levels and all sorts of wave counting and everything. Right. The structure, the price is king. That is the one we listen to. If you want to become consistently profitable in the market, then price is king. Bottom line, right? Well, so then one of the questions people ask is, why do we have indicators? Why do we look at this support and resistance levels? It's very simple, guys. They help us. They can help us to clearly, to better see, we can define the structure of the market a little bit better. Some guys I know don't use it. Let me just see how do I get rid of this thing. Yeah, let's erase all this. Some guys, let's get to the pointer. That's it. There's a pointer. Right. Some guys, it's what you're leaning on. Right. Do you put emphasis on the indicators, or do you put emphasis on the price? The indicators, as I'll show you now, can serve a purpose, almost like a king when he has knights to advise him. The knights are only there to advise him. He takes the decisions. So that is what we use indicators for. I haven't got time to go into all of these indicators in detail. So if you're interested, you can see there's some recorded webinars where you can Google, and we've got our glossary as well, and some other places we've got in our education. We've got articles as well which discuss, what is a moving average. Just thinking of it, I did actually a recorded webinar on moving averages, just I think 2 or 3 webinars ago. So if you're not sure, just let me know, then it'll give you some background into what is a moving average. So I've got 2 moving averages, each one with a purpose, no clutter, just everyone with a purpose. And then I've got Williams fractals. That is just an indicator that helps us to identify turning points. And then I've got a momentum oscillator just to help us to see from a distance, what is the overall move of the market. Now, I must emphasize, guys, very, very important. This is in the beginning to help you, like the training wheels. There's nothing that stops you from, when you start seeing that structure, that stops you from removing some of these indicators, and just because you have trained, then you know where the turning points is, you know how the trend goes. There's nothing that stops you from taking them away, because that is what we trade. We look for the early stages of a next trend. So let's go for our first long trade. We have got a downtrend here. If you don't agree, then you must contact me. All right, we've got our higher bottom. The price breaks through, makes a higher top. Definitely a break of that structure, that lower, that downtrend structure. And there we've got the early stage of a next trend. So how do we do that? This method, the way I define it, simple and defined in this method, is as follows. I've got 4 indicators, as you've seen. I've chosen the 34 simple moving average very simply because it's just sort of like a dynamic trend line. So when it's below, when the price is making waves below the trend line, then it's easy to see it's a downtrend, right? When it starts breaking through, And that's the point we're looking for then. When you start practicing, I assume you don't know a lot. So what do? What is the things, what makes it well defined for you? First thing is it will break the 34. If the price starts breaking the 34, then you know this is a warning of the market. I must start paying attention. I must check every candle after the close so I can check the structure, what's happening on the structure. Remember now, when the price is breaking through here, you would not know what happens there. That would be, nobody knows what's going to happen there. So we are simulating in this. So this is the purpose of this 34. Now, the 15 simple moving average is a bit faster, so it's closer to the price. And the simple, we've got our breakthrough here. What are we waiting now for? We're waiting for the market structure to give us a good entry point. The 15, the purpose of the 15 is for us to clearly see the market pulling back to this. So the market breaks through, it starts pulling back to this indicator. We're still focusing on the price. The indicator just helps us to see it very clearly. And we're going to look at a couple of examples when I'm finished. Some live examples if you've got enough time. All right, so we focus on the structure, we focus on the price. Okay, and it pulls back to that 15. Makes it easy to see. Right, now the fractal, the purpose of the fractal is to identify turning points for us. You can see there's these beautiful turning points there. There, the price breaks through the 34. It makes a turning point, pulls back. So it's just easy to see, but the real value in this lies that the market pulls through, and when it breaks past that first one, then that is where we will want to take a calculated risk, right? So what happened is the price broke through, pulled back, and now it's going past that fractal point. Like I said, when you get to know the structure, when you get a little bit more confidence, you can take that away. It's not needed. It just gives you confidence in the beginning while you're training, while you are practicing to see the structure of the market. Where will I enter? Where is the market speaking to me? So the indicators just supports that, give you a little bit of confidence. One classic mistake guys make is they think the method itself is going to make them a lot of money. Guys, it's not true. You have to get to understand the structure. The method is where you put a couple of indicators with, and then in the beginning, since we are not never ever trying to predict the market, we don't know what's going to happen. We only take a calculated risk based on this wave structure when there's early stage of an X trend. What is the most important thing you've got to practice? Why you need this method in the beginning is just to realize that it's not a trade or 3 trades that's gonna do this. We don't know how it's gonna play out. We never know. We take that calculated risk as long as the structure stays intact, lower bottoms or higher tops, higher bottoms in this case, then we will stay in there and manage our profit. But many times the market will engage you and just turn around and the structure is broken and you must take a loss there. You must protect your account there. All right. So it's critically important to understand from the start, you're going to have to practice sample sizes. I'm talking about 20 trades minimum in a row. And you see what the net effect of that is. When you listen to the structure of the market, you take calculated risks and you manage your risk well, then it is very possible to make a net profit over a series of trades. However, in the beginning, because you haven't got the skills, you don't understand the language yet, even just getting to break even is going to be a challenge for you. It's going to be very good if you get to break even. So the only purpose of this is to help you with that training, to start seeing the structure, to start to be able to, because it's simple and well defined, to be able to start practicing those sample sizes, do 20 in a row, you see. As you practice, just like with a bicycle, just like any skill, as you practice, it gets easier because you build up this muscle memory. But that said, I must emphasize that what you practice must be correct. It doesn't help you take, you lean on support and resistance or some indicators, and you practice that. That's what you think is important. That's gonna just nail you, right? The structure is this thing that defines what the market is saying, and we listen to the market. Okay, and I'm saying a lot of heavy things here, but just hear me out. Make notes if you want. Like I said, email me if you have questions. If you want to listen to this again, and I send it to you. Right, so that is the third indicator. Now the fourth indicator is just sort of like an overview, right? The market is now broken through, it's pulled back, and as the price is going up there, we just want to see what is going on from a distance, right? The momentum indicator is very nice because it's got a waterline, 100 waterline here, and in general, when it's below the waterline, there's no clutterness there. It's just very simple. It's a simple line. If it's below, then it's normally the market is bearish, so there's more sellers in the market. And as it breaks through and it starts making waves up, it's delayed, so it's not perfect. Then it's just going to confirm to you. Sorry, my eyes are tired, so I'm just going to press on here. And we just want to confirm that it's above the 100 in this. So if it was a low, we'll see at the short trade now. If it's a short trade, then it must be below. But with this one is a long trade, so it must be above. Right. What is very nice as well, just to make it more simple and well defined for yourself, is to write it down, guys, so that you can. It's almost like a recipe for good rusks or whatever, or good cake or whatever, cookies. Then if you've got the recipe, then it's easy to, when you practice, just go back to the recipe, write it down for yourself, take a screen print or whatever. I'm not allowed to send you the slides, but you can watch it again, take a screen print. We want definitely a confirmed trend. We want that compression happening, like the spring being compressed, and then at some stage the market warns us and there's a breakout. It's that spring being released, right? There's a good opportunity. The odds are in our favor for at least some, because of the compression, some release there. And that's why we use a high probability risk management and money management, where we start taking partial profits early to make the mental stress less, and because we don't know what's going to happen, right? But please, partial profit, not everything. I'll show you now. Right, definitely we want the trend to break out. We want the price above the 34 moving average. We want a pullback to the 15, as I just explained. And then yeah, I'm gonna have to go faster. Time is catching. Yeah, the hour is not a lot. Right, we've got that fractal that needs to break, makes a fractal, pulls back, and then it goes past the fractal again. We're going to go through a short one again now, and the momentum must be above the 100 baseline. Right, exit rules, extremely important. You must know before the time where you're going to put your stop loss, where you're going to protect your account when the structure breaks, when it's not an up or downtrend anymore. In this case, when it's not an uptrend anymore. Before the time, guys. You can't be worrying inside the time, because then the emotions are gonna just give you a lot of hassles. Right, in this case, I've chosen the stop loss to be at 34 just to make it simple. Right, normally I like market structure, but if you're practicing, if you're still practicing, you haven't got the skill of taking executing that simple method, that recipe, almost like if you over a series of trades to see the outcome. If you haven't got that skill yet, then this method's going to help you. You know exactly where to put that stop loss. It's at the 34 level. The take profit, very important. The market, we don't know what the market's going to do. Sometimes the market is very generous. It's a nice long trend, sometimes not. So you have to be able to survive over a series of trades, to survive a couple of trades that looks like it's a possible begin of a new trade, but a trend, and it doesn't. It pulls back, and you have to protect your account. We take a partial profit when it's 1-to-1 risk reward ratio, and then the rest at the second risk reward ratio. So let's look at it in action. Right, we've got the break through the 34, we've got the fractal, we've got the pullback. There's the entry. It breaks past that one. While it's going up there, we just make sure the momentum is in. We use stop orders here, a buy stop and a sell stop, so it only becomes a market order when it goes past that point. So right, that's our entry, 34 moving average. That's our stop loss. No doubts, no wonder. We know exactly what to do, right? And the skill is we need to do this exactly over 20 trades at least, to see to get that discipline, to practice that consistency, get that consistency level going. All right, that's our stop loss. That is our risk, the pips amount between those two, the entry and the stop loss. If it gets to the risk reward ratio 1-to-1, so if my risk is 10 and it gets to 10 pips, then I take half my position off. This is a very, very nice way for practice purposes, because when you, especially when you start practicing on demo and on a Sense account, a live account, when you take this 50% profit off, it means you've got a break-even trade. So if you risk $10 there, and now it's $10, now you're taking $5 off, it's already in your pocket, 50% of 10, and then the risk here has also been halved. It was a $10, now it's half, the position is closed. So you've got 5 in your pocket, and there's 5 risk, so it's actually a break-even trade already. You can let it go until the market structure changes. And if you check here, there the market structure goes. For the purpose of training especially, I tell the guys, take your second profit. When you get more advanced, you can let it go the second part until the structure changes. But in the beginning, to keep well defined, so you can start practicing getting that discipline to execute your method over a series of trades like 20. Just leave it there, take it, right? So, and there it goes. Normally, when the structure changes, that's what there's going to be another opportunity. There's time to sell, and then we take whatever profit is left there. Right, so that's an example of a long trade. Okay, Rajesh asks what time frame to use and which pair is the best. That's a very good question. Let me show you quickly what I mean with my answer. Rajesh, every single time frame has a structure, has an uptrend, downtrend. This is the 4 hours. This is a daily. You can see the structure here. There's a bit of a wild moves there. And there you can see uptrends, downtrends. If I go to the 30 minutes, the hours, there's every single time frame has. Ooh, I see the network connection is a bit slow. Right, it's not off. Let's see, it should correct itself now. Right down to the 5 minutes. Especially when I keep it on the line chart, there's a structure. You won't be able to distinguish, except if you've got a lot of experience, between a down. We know if it's a 1 minute, okay, 1 minute perhaps, but if it's 15 minutes and it's an hour and it's a day, if I take away the heading here, and I just show you a line chart, show you the structure of the market, you won't be able to discern which time frame. That's because in every single time frame there is structure. So you trade the ones that you find practical for yourself. All I know is the difference between especially in the beginning, the higher time frames is a little bit more stable because there's more people involved in it. The lower time frames is a little bit more unstable or noisy, as we call it, because there's less people involved in forming it. Right. So that's a difference between the two. So that's why I advise, especially when you're still busy in the beginning, stick to the higher time frames, practice. All right. Now the pair, you get different groups of pairs. Now the FX majors, 80% of the volume of the market happens in these pairs, guys. So I normally tell the guys, choose a pair here, choose a couple of pairs here. Just remember some of them are correlated. The minors and the exotics together, it means in all the spots and stuff, is 20% of the volume. No, not the spots. Just talking about the foreign exchange, the currency pairs. So 80% happens in these majors, and 20% in the rest, the minors and the exotics. So if you become an expert trader, yes, some guys like some of these, the personality of some of these exotics, of minors, but for the most part, I like to trade with the volume is. So that makes it very simple. Right, let's see. Let's go on with our presentation. After the short trade, then I'll look at the questions again. Right, let's just see. I see another question pop up. Tabu says that I seem to be very strict with requirements for a confirmed trend. If there is no confirmed trend, no trade can be entered, even if there's a clear pullback or reversal. Right, guys, if there's no clear trend, uptrend or a downtrend, then it means you're in a ranging market. An arranging market is very simply, let me quickly go here, when the market chose the wrong thing there. A ranging market is simply when the market does things like that. There's no clear uptrend or higher tops, higher bottoms. That is what our professor calls a killing field. That is where people wipe they clean out their accounts. Yes, if you take a calculated risk, it's going to help you a bit, but you haven't got that compression power that's working with you, right? If it's a downtrend, then if there's a downtrend that was going, then there's a lot of the spring is compressed by the suppliers taking the price down, or the lack of demand that's taking the price down, and that spring is very compressed and it wants to release, and there's a high probability of a release to catch your first take profits there, right? Like we're doing there. When it's a ranging market, then there's no compression. Yes, there might be some impatient guys, or they're waiting for news, and when the news happens, the market booms out and sometimes gives a pullback and you go back. But that is some opportunities that you can look at later. But for the start, I just stick with the simple, very high probability early stage of a next trend. I like that. So if you can master that, you will get your cash flow going in this business easy. Right. So the beginning, in the beginning, for the beginning traders, just to get to break even or make a profit is actually a very tricky thing. Right, time is running, so I'm just gonna, okay, we look at another trade. There was because it doesn't always work out, you must realize that. So there was the 34 was broken. It made a nice top there, higher top there, fractal. It pulled back to the 15 and it broke through. We took our trend there, we took our entry there, and what happened? We put our stop loss there, and the market just couldn't continue further. We left it, waited. If it made a nice pullback there and went up, do a good trade. If it made a pullback and it comes down, then I would have moved my stop loss a little bit perhaps there, because the structure is now broken. It didn't, it just continued down, and I let it go and it takes me out. Is this a bad trade? No, it's not a bad trade, guys. Sorry, my eyes are a bit tired. Been spending a lot of time with Skype sessions and stuff in the day. Right. So is this a bad trade? No, it's a good trade. I protected my account. A bad trade is if you either don't listen to the structure of the market, you just jump in anyway, or if you don't take a calculated risk, or if you if you don't manage your risk very well. You don't take your profit, you move your stop loss and stuff like that. That's a bad trade. And bad trades being randomness into your trading, and then it's very difficult to make a net profit over a series of trades. We want to trade good trades where where our foundation is correct, and then the probability goes up drastically if you're making a net profit over a series of trades. Right, that's our risk, and in this case, the stop loss was reached. Still a good trade. Right, just to save some time, I'm going to not talk a lot about this. We've got our same indicators. In this case, we've got a higher top, a higher bottom. Remember, guys, I'm not looking at the candles, individual candles here. I'm looking at the structure of the market, right? So that's why I gave you that tip in the beginning. If you get confused by the candles, then go simply to a line chart and practice that structure. Right, so we've got a uptrend here, makes some puffling, makes a higher top, higher bottom, higher top, higher bottom, and then something happens here. We don't know what, but definitely the structure is changing. Right, and we can see that break there. Very, very important. That's the warning of the market that we can start looking in this method for an opportunity. So I'm not going to spend too much time here. I want to look at a couple of examples. Again, the purpose of the 34 is just like a dynamic trend line. Instead of drawing it, I have it here on the chart, actively being updated by the system. It breaks a 34. Okay, it pulls back to the 60 or to the 15 simple moving average. That's the purpose of it. Now immediately what you see is here's the first fractal here, but the market didn't pull back a lot. Didn't pull back. Then it went down lower, and then it pulled back to the 15 simple moving average. That's the fractal we're interested in. I've had some questions about that as well. So it's the one just before the pullback that's important. Sometimes the market may make a few of them there. In general, I don't like trading then, but in this case, it's just a small pullback then, not a deep enough pullback. And there we had our proper pullback. We wait. Patience is very, very important. When it goes past that line, we take the trend, and let's just see what our at that area, what is moving or the momentum saying? Definitely down, just a confirmation. Short rules again, confirmed downtrend, because this is a confirmed uptrend actually, because it's a short trade we're going to take. It breaks out to the lower side. It breaks below the 34. It's a pullback to the 15. The entry is past the fractal. Just the opposite of the long trade. The momentum is below the 100. Exit rules stays exactly the same. Stop loss is at the 34. First take profit 1-1. Second take profit 1-2 risk reward. Right, so let's look at this one. There was definitely a up move there. There the price broke through the 34. Didn't do a good pullback there. It went a little bit lower and then it pulled back. It's so nice, guys, when you practice this, you put in screen time, right, and you start seeing this action. But you must realize, and that makes it very difficult for the mathematics guys and the science guys, is because these waves, uptrends, downtrends, this is caused by people buying and selling. We've got buyers coming in here, more buyers than sellers, that causes the price to go up. Every single the principle stays the same, the structure stays the same, but the way the structure manifests here is every single time it's unique. It's never exactly the same. It can't be. It's a point in time which is past. The people that caused this structure, for the reasons, whatever reasons they had for buying, it's gone. The guys that are causing this is other people trading for other reasons, right? So that is why this thing about trying to predict the market is so dangerous. In fact, Michael Douglas in his book Trading in the Zone says that the moment you think you know, the moment you think you know what's going to happen, you're already in trouble, right? Already your mind is closing up opportunities for you, and you're not looking objectively at the structure of what is the market actually saying. That's why people get into trades at all sorts of weird places, and afterwards they tell themselves, what did I, why did I take this strange decision? It's because you believed something, you believe what the price is going to do. We don't do that. We identify these early stages of an exchange, we take our calculated risk, and we let the market structure play out. All right, so let's see what happens here. We take our entry. That's what our entry would be. It breaks past this. The 34 simple moving average is our stop loss. That's our risk. It gets to 1-to-1, we take our first profit. And either if the structure changes or it takes our first take profit. And this is a very good exercise. We'll look at 1 or 2 now. We've still got time. All right. So, and in this case, our profit target was reached. Very, very important. It will be reached sometimes, but we don't know and we don't care. We wait for the structure. Each and every trade is unique. What do we know? We don't know what the trade, what the trend is going to do, how long it's going to be, even if it's going to reverse. But we can see our method, the specifications of our method, simple and well defined. And then we let it go. We let the market do its thing. If it changes structure before the time, then yes, we can take the rest of our profit. That's why I do a lot of webinars where what I call the moving average spring strategy applied as well, where I touch on different aspects and we look at live trades, trying to find live trades, and or going back at the different currency pairs, different time frames, and identifying possible trades. Right, again, just another example. We've got a break of our 34. We've got a beautiful pullback to our 15, a nice deep enough one. Your eye gets used to this. So that is why screen time practice is necessary. There's our fractal, there's our entry. The price does go past that and then starts piffling. We leave it because it might go down. We are respecting the structure, right? There, the structure changes definitely, and our trade gets taken out. So in that case, a stop loss was reached, and again, it is a good trade, guys. We took the risk over a series of trades. Then if you apply your method, then it becomes possible to make a net profit. If your trade engages and you start messing with it, you think, oh no, it's going to go up, and you stop it out here. Over a series of trades, it's absolutely deadly, because many trades will then just turn around and the structure is not violated and it continues down and you lose all that profit. So we cannot afford to do that. We need to let the market structure play out. That's very, very important. That's also a nice thing. Just before I go to the risk management, that's a nice thing to do. Is if you have been trading and you feel you're not making it, or even if you are have a simple, well-defined method like this one, or the failure swing the professor uses or explains, then go back, look at your old trades. See what was your reasoning. Identify the ones where you make mistakes, you moved your stop loss or whatever. See what would have happened. That's part of the learning process, and then you realize after a while, let's just let this thing play out. If I mess with the trade, if I move my stop losses and stuff prematurely before the structure tells me, then you miss out on opportunities, and that's what you see as you practice. Right. Very quick risk management. That where you take your profit is actually money management, but that's part of risk management for me. In fact, I call that first take profit of mine. If it would have taken the profit there or there, sorry, I call that first take profit actually my risk management take profit, right? Because the moment I hit that one and it's close, then there's a high probability of being hit. Then my risk is less. With this money management scenario, then the risk is actually zero. It's a risk-free trade, right? But there's many types of forms. Risk management that I'm mentioning here is how much of your account are you risking per trade. I don't care how good a trader you are. If you trade with a substantial amount, percentage of your trade, then of your account with each trade, then that pressure, that mental pressure will affect you. It will affect you guys. So that is just a fact. So especially the guys with big accounts, but practice it in from the start is a low use small percentages of your account. And this is a very good way to illustrate. If you lose 5% of your account, let's say you trade 1%, you risk 1%, then and you lose 5 in a row, then you need to get to break even only 5.2%, and that is quite possible. If you have a nice consistency in you, you've got a simple, well-defined method that you exercise that helps you to catch those early stages of a next trend. If you lose 30% of your account, then you have to just to get the growth you have to get to break even is 42%. That's very difficult, guys. For experienced trader, perhaps, but I don't know any experienced traders that get to 30%. If you risk 2-3% of your account and you get to 2-3 trades that you've lost, you go and check if something is wrong. What is it am I premature or whatever? It sometimes does happen, but to get to 30%, it is not so probable if you have a stable foundation. Right, if you get to 50% of your account, then you need to grow. You need growth of 100% just to get to break even. That's very, very difficult. If you ever get to 50% of your account lost, then just hands off, get back. Then something is wrong, guys. Something is wrong. Something wrong with your consistency, with your early stage of a next trend, with your amount you're risking. And just for interest's sake, if you lose 95% of your account, then you have to make 1,900% just to get back to break even. So that is almost impossible. And it's time to go back and check. Unfortunately, people don't respect this, and then they blow their accounts. So what happened 2 weeks ago in the Monday, a lot of good traders, or a lot of traders I've seen, strategy managers that don't manage their risk very well, they just blew out, guys. So that is why even if you follow a strategy manager, then you must learn how to manage. You must learn how to choose strategy managers, right? Very important. If you get a good foundation, if you build, you listen, you get that ability to learn, you get that ability to consistently execute your whatever method you in the end choose, and you get that ability to make a net profit over a series of trades. If you get that skill is really valuable, even if you don't have a lot of capital. What you can do is you can actually become a strategy manager. That skill that you've acquired, that experience, you can share that with other guys. And what they can do is we train the guys, we train investors. The guys are new, that have no knowledge, that are busy learning. We train them how to look for, based on the equity curve and a couple of things, look for good strategy managers. All right. And then these guys can link with you. They've got their own account. They can track you. They can decide. We teach them how to look for good strategy managers. If a strategy manager account looks, or his equity curve looks like this, yeah, then it is not good, right? This guy is not, the red line is too deep drawdowns. He's not taking calculated risks, not managing his risk very well. But as you can see, this growth is beautiful. This guy's taking calculated risks, managing his risks well, and if you take it in the early stage of an next trend, with each and every trade you take, then the possibility is high for you to make more profit than you are taking a risk. Very, very important, guys. Okay. Again, very important. You've got your own account. You are trading. The client has got his own account. He puts funds in there, and he chooses a strategy manager and then creates a link. The money is transferred. And when this guy, you in this case now, takes a trade, then the trade is copied to him, and any profit that he makes, that is made in his account, is shared with you, right? So yeah, we finished. I need a couple of minutes. I just want to check on a live account, see the questions and answers, and check at a few live examples for you guys. Right, let's see what is the questions here. Right. In ranging markets, whipsaw may be there. So it's, how do we detect a ranging market and a trend market? Right, that's a good answer. That is why it's so important for me, for you guys to, if you have any doubt, guys, about what a trend looks like, about how to define it, use the beginning, take away all the indicators and stuff, use the line chart, because the line chart lets you see the trend, the structure of the market without any emotions, right? So it just makes it a little bit easier before we go to the candles where there is emotions involved. And what I teach the people is to simply, let's go to another time frame, a 30-year, and to simply look for higher tops and higher bottoms. You can see there was higher tops and bottoms. That is an uptrend. Something happened here. There was a very small, it's not really a downtrend, it was just a break, small downtrend there, and there it continues. The reason why I chose the 30, you can see there was a little bit of a breather again, and there was a breather again, and there's a downtrend. The reason why I chose the 30 in this case is because we've got signals on our website, which you can go and find, and then in the signals we've got an indicator that defines the structure for you, and we do those signals before London open and before New York open. So guys that are busy training, that needs a bit of support, confidence, can go and look there and can see, is the setup that I see, is it a possible setup there, right? So so what I'm saying is, Ujesh, is to take this to identify, to train your eye to quickly, to be able to see the structure. Lower tops, lower bottoms is a downtrend. Higher tops, higher bottoms is an uptrend. And there we see a bit of a ranging market, not really higher tops and bottoms in that area, right? So it's very, very simple. But the simple, it is simple, yes, but it's not easy, because although the structure stays the same, as you can see, the individual waves is always different, the character of these, the structure is the same, lower top, lower bottom, lower top, lower bottom, but here it's higher tops, higher bottoms, but it doesn't look the same. It's unique because there's different people that cause that. All right, that is why it takes practice, screen time, to get used to this, to train yourself to be able to do this. Right. So, and even drawing will differ from different people. So what you can see is you've got higher tops here, but and then it continues. Right. So it continues there, and then you've got this decent break here. So go and practice that. I hope it answers your question, but keep it simple. Right, when you put the candles in, then you see the emotions as well, but you can still see the basic structure. If you have difficulty, then do what that other guy did and start drawing it in. Yeah, you've got your top, a bottom, a higher top, a higher bottom. Right, sharp. So if this was easy, I think everybody would be able to do it very quickly. It's simple, but it's not easy. It takes practice, guys. So what I'm going to do now is got some minutes left. I've actually got another training session after this, so I'm going to go to a template with spring strategy, and let's look for a couple of examples. There's a beautiful one here. You can see obviously the price is above the 34 moving average. It breaks through there. Okay, there was a pullback. Might have been, if you're more experienced, you might have taken that. But for us, we don't. We are waiting for a fractal. There we've got our first fractal. We put that is our entry, possibly be if it comes past, then the price goes up. We see beautiful, it goes too close to the 15, and then when it comes down, when it starts coming down, we put our orders in there. Right, I've got some moving average spring strategy applied where I show the orders as well, how to put in the orders and everything. So if you need to see that, you can just let me know, email me as well. Right, so it goes down, and there, where would our stop loss be? The 34. That's where we put it in. There's the 34. There's our stop loss, simple and defined, and there obviously would be our first roundabout. There would be our first take profit. Right, so we let this thing be. It's still definitely a downtrend. There it breaks down. It makes, very important, a lower top, and then continues. That's why we took it there. That's why we only entered there. Don't wait for the close of the candle. As soon as it starts going down, our reasoning is if it breaks that point, then it means it's going to make a lower bottom, and then we are willing to take the risk. So, and this is still, even if that candle goes up, doesn't matter, it's still a downtrend. What we're waiting for is a couple of candles, and we'll see how the structure goes. If it changes, if something happens and it changes, then it makes doesn't make a, remember the definition, lower bottom, lower top, lower bottom, lower top. If it doesn't make a lower top and it starts going up, then it might be the 34, depends on where the 34 curves, it might be the start of an early trend, and then we will definitely take the rest of our profit off, because if it didn't make a lower bottom there, and if it goes up, it's going to make a higher top. So the market is telling us, get out, the structure is changing. All right, let's see. Yeah, it's got a couple of minutes left. Let's look at another one. I'm going to another time frame. Let's see. We've got, no, that's not a clear one. And I like a breakthrough and then a pullback. So here we've got a breakthrough 34, but we don't have a fractal here. It can still go here. There's our fractal, there's our pullback to the 15. So if this thing goes up, then there's our 34. There will be our, oops, there will be our possible trade there. The only problem I have here is, you can see this is this really early stage of a next trend. Market dipped very low, and then the trend has actually progressed quite a bit. I normally like to catch our trade somewhere around here. So this makes me a bit nervous. Right. So that's what's going to happen to you. You're going to grow your insight as you grow. There's no way, guys. You can listen to somebody speak a language forever. It's not until you start practicing yourself that you can master that language. You can speak and use that language. It's the same here. So I've got a lot of students, that clients of us, that they watch the webinars again and again, starting. That's the nice thing about the webinars, as they are learning, taking their steps and learning this skill. It's a very, very handy skill, especially with all the lockdowns now. People have got time to practice. So I've got a lot of webinars, one-on-one and groups, that of where people are asking questions so they can learn and grow. Right, we're at 4 o'clock. I've unfortunately, like I said, got another session now, so I'm gonna say goodbye. Let's just see. No more questions. Just thank you. Yeah, thank you for you coming and learning. And I really enjoy teaching this language of the market. This is like music to me. When I look at this charts, then I see this beautiful structure here. I see the opportunities. Guys, this is a business like no other. If you master the skill, then it's really worth it. Right. Okay. I'm gonna shut down now. See you guys next time. We're gonna have more webinars in the next couple of weeks, because of the lockdowns. We can't travel. So we keep our eye open and contact me, and then we can take it from there. Okay. Have a nice day. Goodbye.